let's take the next lesson where we are discussing about payback period. We are doing investment appraisal techniques, and we said that investment appraisal techniques can either be discounted cash flow techniques or non-discounted cash flow techniques. Discounted cash flow techniques comprises of net present value, internal rate of return, profitability index, discounted payback period. I think that those are the mention discounted payback techniques, which we have already discussed and uploaded in our YouTube. Today we discuss the remaining two, which come under non-discounted cash flow techniques, and this is payback period as well as accounting rate of return. We start with payback period. My name is Mr. William of Fatima Institute. My contacts are 0727 8710 93. For more details, you can contact us through that number. Now let's go straight away to our discussion for today, the payback period. Payback period means the time taken by a project to generate cash flow equal to the initial capital outlay. For instance, you purchase a machine for 1,000 shillings. You purchase a machine for 1,000 shillings, and each year it generates 100 shillings. It means after 10 years, that machine will have generated the 1,000 shillings, which is the initial capital outlay. So it is a question of, if I spend a certain amount of money to acquire an asset, out of the expected cash inflows of that machine, how long will it take for that machine or project to generate cash flow which equals to the initial capital which I spent? So to say that for you to calculate the payback period, you take the initial capital outlay, you divide by the annual cash inflow. In that case, in our first example, which appears on the board, example 1, if you look at example 1, the annuity cash flows, we are using annuity cash flows. That is where cash flows are constant. That is a situation where, to calculate the payback period, you will take the initial capital outlay, you divide by the annual cash inflows, which are constant. So we have said that payback period means the time. Payback period, it is time, it is duration, the number of years. It is not a rate, it is not a certain percentage. It is the time, the duration, the period taken by a project or an asset to generate cash flow equal to the initial capital outlay or the initial amount that you spend to start that particular project. Now let's go to our example there. Example 1. Project X costs shillings 20 million. We are taking example 1. We are taking example 1, which is comprising of annuity cash flows. That is where our cash flows are constant. Project X costs shillings 20 million and is expected to generate annual cash inflows of shillings 8 million for 8 years. Required payback period. We have said that in those situations where the cash flows are constant, that is, cash flows are sort of annuities, our formula is initial capital outlay we divide by the annual cash inflow. We divide by annual cash inflow. So the payback period will be equal to 20 million because we have started that project by initially injecting 20 million. You divide by 8 million. This project we have told it is generating cash inflows of 8 million per year. So each year the project is generating 8 million. So if our project is generating 8 million each year, it will take how long to generate 20 million? So that is where we have taken 20 million divided by 8 million, which gives us 2.5 years. That is 2 years, 2.5 years basically. So it means that the first year, that project will generate, there will be cash inflow of 8 million. The second year, there will be cash flow of 8 million, so that becomes 16 million. So you are remaining with, if you have 16 million and you started with 20 million, there is 4 million remaining to make it 20 million. So for the 0.5 of the year, you generate the 4 million to get the 20 million. So basically, we have said that payback period is given by initial capital outlay divided by the annual cash inflow. The initial capital outlay in that question was 20 million, and this project each year it's generating 8 million. So payback period will be 20 million divided by 8 million, which gives us 2.5 years. 2.5 years. So the payback period is 2.5 years. Again, we have said payback period is the time taken by a project to generate cash inflow equal to the initial capital outlay. Now, the challenge arises in those situations where the cash flows are irregular. The cash flows are not constant. If the cash flows are not constant, then our formula that we have used in our example 1 may not apply. Now let's look at example 2. If you are able to look at our example 2, you look at our example 2, just go to example 2 where cash flows now are irregular. With the cash flows, where the cash flows are irregular. Now you can see that example 2, that we have non-equal cash flows. Let's have an example. Consider a 5 years project whose cost is shillings 2,400,000 with the following cash flows. You have year 1, 2, 3, 4, 5. There are 5 years. Now the cash flows, these are in terms of thousands. You have omitted 3 zeros there. So cash flow for year 1, this project will generate 950,000. Year 2, the project will generate 840,000. Year 3, the project will generate 760,000. Year 4, 794,000. Year 5, 800,000. Those are the cash flows. You can see the cash flows are irregular. They are not constant. They are non-equal cash flows. It is not as in the first example. If you look at the first example that we have done, we have just taken our formula directly by taking initial capital outlay of 20 million over the cash flow which is being generated per year, which is a constant of 8 million. That cannot apply in this situation where the cash flows are irregular. So let's calculate our payback period. What are we supposed to do? We are supposed to accumulate our cash flows. So have years 1, 2, 3, 4, 5 downwards. Have their cash flows downwards as they have been given. Cash flow for year 1, 950,000. Cash flow for year 2, 840,000. Cash flow for year 3, 760,000. Cash flow for year 4, 794,000. And cash flow for year 5, 800,000. So you open the other column for cumulative cash flows. We know how to accumulate cash flows. So you start the first year. Cash flow for first year is 950,000. Now for the second year, we accumulate 950 plus 840,000. We get 1750. Then 1750 plus 760, you get 2550. 2550 plus 794, you get 3344. 3344 plus 800, you get 4144. I believe you understand how to go about cumulative or accumulation of numbers. I think in statistics you didn't cumulative frequencies in statistics. So you are accumulating these numbers. So whenever you have cash flows which are irregular, which are not constant, the first thing, whenever you are calculating the payback period, you have to accumulate those cash flows. You take the cash flows for the first year plus the cash flows for the second year. You get the second, that is 1750. We have taken 950 plus 840. You get 1750. 1750 plus 760. You get 2550. And 2550 plus 794, you get 3344. Then that 344 plus 800, you get 4144. Now once you have gotten that, once you accumulate those cash flows, the next thing is to apply your formula now. Now your formula now is different from the one that you have done for the previous question, for example 1. You take the payback period is equal to the year before full recovery. Remember that this project cost you 2,400,000. So because a payback period means the time taken by a project to generate cash flow equal to the initial capital outlay. If we are saying that this project, we started this project with 2,400,000, we are asking ourselves, and it is generating these cash flows here, year 1, 950, year 2, 840, year 3, 760, year 4, 794, year 5, 800. When or in which year will this project have generated the 2.4 million, which is the initial capital outlay? So we look at, we establish now our cumulative cash flows or cumulative cash flows. Now you look at year 1, we have 950. So the 950,000, we have not yet generated 2.4. When you go to year 2, because in year 2, we generated 840, so 950 plus 840 is 1750. So 1750, we have not generated the 2.4. But in the year 3, we generated 760. So if you take 1760 plus 760, you get 2550. So it means in the year 3, already we have generated more than the 2.4 million. It implies that 2.4 million, which was the initial capital outlay, is between 1750 and 2550. So you can see what I have written there in the year 2. So this project generated 2.4 million in the year 2, but after, and not That's before year 3, but after year 2. Because in year 2, we have 1750, and in year 3, we have 2550. So 2.4 million is in between year 2 and year 3. So our formula, which I've given you there to get a payback period, you take the year before full recovery. The year before full recovery. The year before full recovery is the second year, because in the second year, we have 1750. So the year before full recovery is year 2. So you write 2 plus cash to full recovery. The cash to the full recovery. In other words, when we are in the year 2, we have 1790. We have 1790 and 1790. So how much is, I think it is 1750. I think it was 1750. Then how much is remaining? How much it is remaining to get 2.4? Because you are saying the cash to the full recovery in the year 2, that should be 1790, not 1750. 1790. If you look at year 2, our cash flow for year 2 is 1790, but year 3 is 2550. So 2.4 is in between 1750 and 2550. So how much is remaining to make it 2.4 when we are in the year 2? We have 1750. So 2,400,000 minus 1790. We have rectified that. It's not 1750, it's 1790. 2.4 million minus 1790,000 is 610,000. So 610,000, I think if you take 2.4 million plus 610,000, you get 2.4 million. So our formula, we are saying the payback period will be given by the year before full recovery, which is 2. The year before full recovery. Because if you have 1750, you're only remaining with 610 to make 2.4, which was the initial capital outlay. So the year before full recovery, which is 2, plus the cash to the full recovery, which is 2.4 minus 1790, which gives us 610. So 2 plus 610 divided by cash for the year of full recovery. The year of full recovery, which is the third year, is 760 divided by 760. So 610 divided by 760 is 0.8. So 2 plus 0.8 is 2.8. So the payback period is 2.8. The payback period is 2.8 years. So basically that is how we calculate payback period. That is how we calculate the payback period. You have said that payback period is the time taken by a project to generate cash flows equal to the initial capital outlay. There are two situations. One, a situation where the cash flows are constant, or the annuity cash flows, as we have shown in our first example. So where cash flows are constant, that presents a very simple way of obtaining our payback period, because you'll be taking initial capital outlay divided by the cash flows per year, cash flows generated by the project per year, and those cash flows are obviously constant. Then you'll have gotten your payback period. The second situation arises where the cash flows are not constant, like as in our second example, whereby you have said the project cost you 2,400,000, But for these 5 years, the cash flows being generated are different. Uh, the project is generating cash flows which differ in terms of, that is to say, they are non-equal. Like for example, the first year it was 950, the second year 840, the third year 760. These are in terms of thousands, remember that. The fourth year 794,000, the fifth year 800,000. So in which year out of these years did this project generate 2.4 million? We've said the first thing is to cumulate the cash flows. So open a column for cumulated cash flows, and then the payback period, you ask yourself, in the third column, that column for cumulative cash flows, in which year did we generate 2.4? Obviously, you can see in the third column, we do not have 2.4 million, but we can see it lies between the 2.4 million lies in between 1750 and 2550. So it is in between 1750 and 2550. It is in between the second year and the third year. So we take, if we are saying it lies between second year and third year, it means that in the second year and some months, we had generated the 2.4. So you take 2 plus the cash to full recovery. When you say cash to full recovery, you are looking at the 1750. You ask yourself, is it 1790? In other words, there is a written wrongly there. 1790, the difference between 1790 and 2.4, which is 610,000. So 610,000 divided by the cash flow for the year of full recovery. You can see in the third year, we generated 760. So you take 610 over 760, which is 0.8. So the payback period will be 2 years plus 0.8, which gives you 2.8 years. My contacts are there, 0727 87 10 93 or plus 254 727 87 10 93. I think that is well explained, is well captured, and with that, we've covered the first non-discounted cash flow technique. You can see with this, we are not using the tables. We are not talking about the present values. The present values interest factors, no, because we are saying these are non-discounted cash flow techniques. The non-discounted cash flow techniques, that is the payback period and the accounting rate of return, do not use we don't consider the time value of money. We don't consider the present value interest factors tables. So, and that is one of the major disadvantages of payback period, or generally speaking, the non-discounted payback techniques. That is, they don't consider the time value of money. They don't consider things like risk. They don't consider things like effects of inflation, changes in interest rates, and similar factors. So that is it for the payback period. That is it for the payback period. So in case you have any challenge, our numbers are there. So remember to subscribe to our YouTube, and so that you may be receiving the updates as and when we upload these lessons. You can make a comment, you can like the video, and if you have a challenge, you can just call. Our number is there. I'm also a publisher. I'm also an author, so In case you need textbooks for CPA and ATD and CIFA, you can still call me. We can supply you with books which contain most of these materials which we are using here for these lessons. You can still get online classes as well as physical classes if you are around Thika town. If you are not around Thika town, then we can give you online classes at your convenient time. So we offer other, or we also teach other areas to do with CPA, ATD, and CIFA or KASNEB exams offered by Kenya Accountants and Secretaries National Examination Board. So that is enough for today. So if you need classes which have discussions for net present value and internal rate of return, you can still have them in our YouTube channel, Fatima Institute. They have already been uploaded. You still be having other uploads as time goes on. So keep on checking what is being uploaded. So that's enough for today. So let's meet next lesson. Thank you.